Look, I'm not going to sugarcoat this. If you own silver right now, you're sitting at one of those rare crossroads where the next move you make could define your financial future for the next decade. And I know that sounds dramatic, but stick with me here because what's happening in the silver market right now is something most people won't see coming until it's too late. Silver just hit $65 an ounce. Let me say that again. $65. That's a 115% rally this year alone. And while everyone's celebrating, popping champagne, posting their gains on social media, I'm watching something else entirely. Something that should make every silver owner stop and ask themselves a very uncomfortable question. Am I about to make the biggest mistake of my investment life? Because here's what nobody's talking about. This isn't 2011. This isn't some speculative bubble driven by fear and hype. What's happening right now is fundamentally different. And if you don't understand the distinction, you're going to get caught on the wrong side of history. Let me take you back for a second. December 17th, 2025. Silver touches record highs. The financial media is going crazy. CNBC's running segments about the devil's metal finally having its day. Bloomberg's got analysts predicting $100 silver. Your neighbor who bought Silver Eagles 5 years ago is suddenly a genius. Everyone's asking the same question. Should I sell now and lock in profits or hold for the big move? And that's exactly the wrong question. See, most people are looking at this through the lens of price. They see $65 and they're thinking about their entry point. Maybe you bought at $18, maybe $24. Maybe you were one of the smart ones who loaded up at $15 during the 2020 crash. You're sitting on massive gains and your brain is screaming at you to take profits. That's human nature. That's what we're wired to do. But here's what your brain isn't telling you. The reason silver is at $65 has nothing to do with speculation. This is the 5th consecutive year of supply deficit. Let me explain what that means in plain English. For 5 straight years, the world has consumed more silver than it's produced. Not by a little bit. We're talking about a structural shortage that's getting worse every single year. The Silver Institute just released their numbers. Global silver demand hit 1.2 billion ounces this year. Production, 830 million ounces. That's a 370 million ounce deficit. And unlike gold, which mostly just sits in vaults looking pretty, silver gets consumed. It goes into solar panels and gets installed on rooftops. It goes into electric vehicles and gets driven off the lot. It goes into 5G infrastructure and gets buried in cell towers. Once it's used, it's gone. There's no economically viable way to recycle most of it. Now, you might be thinking, okay, supply deficit, I get it. But that's been the story for years. Why is this different? And that's the million-dollar question. Or should I say the $100 question, because that's where this is headed. Here's what changed. China just announced they're accelerating their solar panel production targets. They want to add 500 gigawatts of solar capacity by 2027. Every single one of those panels needs silver. The average solar panel uses about 20 grams of silver. Do the math on 500 gigawatts. We're talking about an additional 130 million ounces of silver demand just from Chinese solar per year. But it gets better, or worse, depending on which side of this trade you're on. The electric vehicle revolution isn't slowing down, it's accelerating. Every EV uses about 25 to 50 grams of silver in its electrical systems. Global EV sales are projected to hit 30 million units next year. That's another 750 to 1,500 metric tons of silver demand, and that's conservative. Then, you've got the AI data center boom. These facilities require massive amounts of silver for their electrical infrastructure. Microsoft just announced they're building 50 new data centers globally. Amazon's building 40. Google's building 35. Each one of these facilities uses tons of silver. Literally tons, so you've got industrial demand going vertical. But that's only half the story. The other half is what's happening in the monetary system. And this is where it gets really interesting. Central banks bought a record 290 tons of silver in the first 3 quarters of this year. Now, that might not sound like much compared to gold, but here's the thing. Central banks haven't been accumulating silver like this since the 1960s. Why now? What do they know that the average investor doesn't? I'll tell you what they know. They know the dollar-based monetary system is under stress. They know that BRICS nations are actively working to create alternative payment systems. They know that the U.S. national debt just crossed $36 trillion, and there's no political will to stop it. They know that when the next crisis hits, and it will hit, precious metals are going to be the only real money left standing. But here's where it gets really wild. The COMEX, which is the major exchange where silver futures trade, is showing something unprecedented. The ratio of paper silver to physical silver has never been higher. There are claims on every physical ounce of silver in COMEX warehouses that number in the hundreds. Some analysts are saying it's 500 to 1. Others say it's higher. What does that mean? It means the price you're seeing right now, that $65, isn't real. It's a paper price. It's what people are willing to pay for a promise of silver. But what happens when people start demanding physical delivery? What happens when industrial users who actually need the metal start competing with investors who want to hold it? I'll tell you what happens. The price goes parabolic. Let me paint you a picture. It's 1980. Silver hits $50 an ounce. The Hunt brothers are trying to corner the market. The exchange changes the rules mid-game. Silver crashes. Everyone who bought at the top gets destroyed. Fast forward to 2011. Silver hits $49. Everyone's screaming about the next big move. It crashes again, down to $14 by 2015. Another generation of silver investors gets wiped out. So, when people see $65 today, they're thinking about 1980 and 2011. They're thinking this is the top. They're thinking they need to sell before it crashes again. And I get it. That's the pattern. That's what history teaches us. But here's what history also teaches us. Both of those previous peaks were driven by speculation. In 1980, it was the Hunt brothers trying to manipulate the market. In 2011, it was retail investors piling in after the financial crisis, buying silver as a hedge against money printing. Both times, the fundamentals didn't support the price. Both times, it was a bubble. This time is different. And I know everyone says this time is different, right before they lose their shirt. But hear me out. The 1980 peak happened when industrial demand for silver was declining. The world was moving away from silver-based photography. There was no solar industry, no EV industry, no 5G. The only demand was investment demand. And when that dried up, the price collapsed. The 2011 peak happened when mine supply was increasing. Miners were ramping up production in response to higher prices. New mines were coming online. Supply was catching up to demand. Plus, industrial demand was still relatively modest. Solar was in its infancy. EVs were a joke. Tesla had sold maybe 2,000 roadsters. Today, mine supply is declining. The average silver mine takes 10 to 15 years to develop. Even if miners wanted to increase production, they can't. Not quickly. And industrial demand is exploding. Not growing, exploding. We're talking about demand that's going to double in the next 5 years. So when I see silver at $65, I'm not thinking about 1980 or 2011. I'm thinking about what happens when you have structural supply deficits meeting exponential demand growth in a world where the monetary system is losing credibility. And that's when I start thinking about $100 silver, not as a speculative target, as a mathematical inevitability. Now, before we go further, let me take a quick aside here because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I put together a free guide that covers exactly how to get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. No sales pitch, just information. Because if what I'm about to tell you is even half right, having some exposure to physical metals in your retirement account could be the smartest move you make this decade. All right, back to the main event. Let's talk about what $100 silver actually means and why it's not as crazy as it sounds. First, let's adjust for inflation. That $50 peak in 1980, in today's dollars, that's $185. So even at $100, we're not talking about new territory in real terms. We're talking about silver getting back to where it was 45 years ago, adjusted for the massive currency debasement that's happened since then. But forget inflation adjustments. Let's talk about the gold to silver ratio. Right now, gold is trading around $2,750 an ounce. Silver's at $65. That's a ratio of about 40 to 1. Historically, that ratio has averaged 60 to 1 over the past century. But here's the kicker. When silver really moves, that ratio compresses dramatically. In 2011, it got down to 32 to 1. In 1980, it briefly touched 17 to 1. If gold stays where it is and the ratio goes to 30 to 1, that's $88 silver. If gold moves to $3,000, which a lot of analysts are predicting, and the ratio goes to 30 to 1, that's $100 silver. If the ratio compresses to 20 to 1 like it did in 1980, we're talking about $130 to $150 silver. But here's what really keeps me up at night. What if this isn't about ratios or inflation adjustments? What if this is about something much more fundamental? Let me tell you a story. In 2008, during the financial crisis, there was a brief moment when you couldn't buy physical silver at any price. The paper price was $9 an ounce. But try to actually buy a silver eagle from a dealer? $25, $30. Some dealers just stopped selling altogether because they couldn't get inventory. That disconnect between paper and physical lasted for a few months, and then it resolved. The system held together. The paper price eventually caught up to the physical premium. Crisis averted. But what if next time it doesn't resolve? What if the disconnect becomes permanent? See, the entire precious metals market is built on a foundation of paper promises, futures contracts, ETFs, unallocated accounts. For every ounce of physical silver that actually exists, there are hundreds of claims on that ounce. And as long as everyone's happy holding paper, the system works fine. But we're entering a world where more and more people want physical, not paper, not promises, actual metal in their hands. Industrial users need physical. They can't build solar panels with a futures contract. Central banks want physical. They're not going to defend their currency with an ETF share. And increasingly, investors want physical because they're starting to understand that paper silver and physical silver are two completely different assets. When that realization goes mainstream, when the average investor figures out that their silver ETF might not actually be backed by real metal, or that their futures contract is just a bet on price movement, not a claim on actual silver, that's when things get interesting. Because here's the dirty secret of the silver market. There isn't enough physical silver to satisfy even a fraction of the paper claims. The entire COMEX warehouse system holds about 300 million ounces of silver. Sounds like a lot, right? Until you realize that's only about 90 days of global industrial demand. That's it. 3 months. Now imagine what happens if just 10% of silver ETF holders decide they want physical delivery. The largest silver ETF, SLV, holds about 500 million ounces. 10% of that is 50 million ounces. Where's that silver going to come from? The COMEX warehouses? That would drain them by a sixth. And that's just one ETF. Or imagine what happens if a major industrial user, say a solar panel manufacturer, decides they can't risk supply chain disruptions and wants to secure a year's worth of silver inventory. We're talking about tens of millions of ounces. Where does that come from? The answer is, it comes from higher prices, much higher prices, because that's the only way to ration a scarce resource. You raise the price until demand destruction occurs, until some users decide they can't afford silver anymore and find alternatives. But here's the problem. For most industrial applications, there is no alternative. Silver is the most conductive metal on Earth. It's the most reflective. It's the best catalyst for certain chemical reactions. You can't just substitute copper or aluminum and get the same performance. And when you're building a $500,000 electric vehicle or a $50 million data center, the cost of the silver is irrelevant. You need it, you pay for it. So where does demand destruction occur? It occurs in the investment market. It occurs when retail investors look at $100 silver and say, "That's too expensive, I'm out." It occurs when small investors get priced out of the market entirely. And that's the irony. The very people who are thinking about selling their silver right now at $65 to lock in profits are the ones who are going to get priced out when it goes to $100, $150, $200. They're going to sell to industrial users and central banks who don't care about price, who need the metal regardless of cost. Let me give you another historical parallel. In the 1970s, oil went from $3 a barrel to $40 a barrel. Everyone thought that was insane. Everyone thought it would crash back down. But it didn't, because the world needed oil. The price had been artificially suppressed for decades, And when that suppression ended, the price had to adjust to reflect real supply and demand dynamics. Silver's been suppressed for decades, not through conspiracy, necessarily, but through the paper market, through the ability to create infinite paper claims on finite physical metal, through a system that allowed price discovery to happen in the futures market rather than the physical market. That system is breaking down. And when it fully breaks, when paper and physical decouple permanently, the price of physical silver is going to shock people. Now, I know what some of you are thinking. This sounds like conspiracy theory nonsense. The market's efficient. Price reflects supply and demand. If silver was really that undervalued, smart money would have bought it all already. And you're right to be skeptical. But consider this. The smart money is buying. Central banks are buying. Billionaires are buying. Warren Buffett famously bought 130 million ounces of silver in the late 1990s. He sold it too early, but he understood the thesis. Elon Musk has talked about silver supply constraints being a potential bottleneck for the EV industry. The reason the price hasn't exploded yet is because the paper market is still functioning. The futures market is still providing liquidity. The ETFs are still allowing people to get exposure without taking physical delivery. But that's changing. Slowly at first, then all at once. Look at what happened with nickel in 2022. The London Metal Exchange had to halt trading and cancel trades when a short squeeze threatened to bankrupt major players. The paper market broke down. They had to change the rules mid-game to prevent a complete collapse. That's what happens when paper markets meet physical reality, and silver's paper market is far more leveraged than nickel ever was. So here's the decision you have to make. And it really is a decision day, because we're at an inflection point. Option 1, you sell now. You lock in your gains. You take your 200%, 300%, whatever you're up, and you walk away. You sleep well at night knowing you made money. And maybe you're right. Maybe silver crashes back to $40. Maybe this is the top. Maybe I'm completely wrong about everything I just told you. Option 2, you hold. You understand that this isn't about trading. This isn't about trying to time the perfect exit. This is about owning a strategic asset in a world that's running out of strategic assets. You understand that the industrial demand story is real, that the supply deficit is real, that the monetary system is under stress, and you're willing to ride out volatility because you believe the long-term trajectory is up. Option 3, and this is the one most people don't consider. You add to your position. You look at $65 silver not as expensive, but as the last chance to buy before it goes to 3 digits. You understand that in 5 years, people are going to look back at $65 silver the same way we look back at $1,000 gold or $10 oil, as a gift, as an opportunity that was obvious in hindsight, but that most people missed because they were too focused on short-term price action. Now, I'm not going to tell you what to do. I'm not a financial advisor. I don't know your situation. Maybe you need the money. Maybe you're overexposed. Maybe you bought silver as a trade, and it's time to take profits. Those are all valid reasons to sell. But if you're selling because you're scared of a crash, because you're thinking about 1980 and 2011, because you're worried about being the last one holding the bag, I want you to really think about whether those fears are based on the current reality or on historical patterns that may not apply anymore. Because here's what I see. I see a world that's electrifying everything. Cars, homes, factories, data centers. All of that requires silver. I see a solar industry that's growing exponentially. Every panel needs silver. I see a 5G and eventually 6G build-out that's going to require massive amounts of silver for infrastructure. I see central banks that are losing faith in the dollar system and accumulating precious metals as insurance. I see geopolitical tensions rising, with BRICS nations actively working to create alternatives to Western financial infrastructure. I see a debt spiral in the US and Europe that has no obvious solution except more money printing. And I see a silver market that's been in deficit for 5 straight years, with no new major mines coming online, with recycling rates that are negligible, with above-ground inventories that are at multi-decade lows. When I put all of that together, $65 silver doesn't look like a top. It looks like the beginning of a repricing, a fundamental shift in how the market values this metal. Let me give you one more data point. In 1980, at the peak, there were about 5 billion ounces of above-ground silver inventory. Today, there's less than 2 billion. The world has consumed more silver than it's produced for decades. We've been eating into stockpiles, and now those stockpiles are running low just as demand is accelerating. It's like we're in a car that's been running on fumes for miles, and instead of slowing down, we're pressing the accelerator. At some point, the tank runs dry, and when it does, the price is going to have to rise to a level that either brings new supply online or destroys demand. Given the timeline to develop new mines and the lack of substitutes for most applications, that price is going to be much higher than $65. Some analysts are saying $100, some are saying $150. I've seen credible research suggesting $200 to $300 if we get a real supply crisis. And while those numbers sound insane right now, remember that silver went from $4 to $50 in less than 3 years during the last bull market. A move from $65 to $200 is only a 3x. We've seen bigger moves in shorter time frames. But here's the thing. This isn't about trying to predict the exact top. This isn't about trying to sell at $109.99 and buy back at $150. This is about understanding the macro trend and positioning yourself accordingly. If you believe the world is going to continue electrifying, if you believe solar and EVs are the future, if you believe the monetary system is under stress, if you believe supply deficits matter, then you should be holding silver. Period. If you don't believe any of that, if you think this is just another speculative bubble, if you think new supply will come online quickly, if you think the paper market will continue to function smoothly, then by all means, sell. But make that decision based on your analysis of the fundamentals, not based on fear of a crash that may never come. Because here's my prediction. And I could be completely wrong, but I'm putting it out there. I think we're going to see $100 silver within the next 18 months. I think we're going to see supply disruptions that make headlines. I think we're going to see industrial users scrambling to secure inventory. I think we're going to see the paper market come under stress as more people demand physical delivery. And I think the people who sold at $65 because they were scared of a crash are going to be kicking themselves when they're trying to buy back in at $120. But again, that's just my analysis. You have to make your own decision. You have to look at your own situation, your own risk tolerance, your own investment goals. What I will say is this. We're living through a historic moment in the silver market. The fundamentals have never been this strong. The supply situation has never been this tight. The industrial demand has never been this robust. The monetary backdrop has never been this supportive. If you own silver right now, you're holding an asset that the world desperately needs and can't easily replace. That's a powerful position to be in. So the question isn't whether you should sell at $65. The question is whether you understand what you're holding and why it's valuable. Because if you do, if you really understand the supply deficit story, the industrial demand story, the monetary system story, then $65 is just a number on a screen. It's not the destination. It's a milestone on a much longer journey. Your time isn't up. It's just beginning. The decision you make today will determine whether you're part of the greatest wealth transfer in precious metals history, or whether you're watching from the sidelines wishing you'd held on just a little bit longer. Choose wisely.